After an initial bout of euphoria after President-elect Trump won the election, Wall Street spent the last week fretting about whether he'll really try to follow through with the less market-friendly aspects of the agenda. You know what comes to mind there? Major import tariffs. There's been a lot of speculation if he'll really be able to follow through, or maybe this is just a negotiating tactic with our trading partners. Call it the art of the deal. Or how much damage these plans could do to the global economy and the stock market. I say let's put the speculation aside for the moment and think about what we already know. Because we know how the stock market reacts when the Trump administration rolls out new tariffs and launches a trade war with China, even if what we saw in the first term was less aggressive than what he's proposing right now. That's why tonight we're going off the charts with the help of Jessica Inskip, the first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as the co-host and founder of the Market Maker podcast. Because we want to get a better sense of the history here and what it means for the president without any emotions involved. As Mark Twain put it, history doesn't repeat itself, but it often rhymes. You know, I kind of like that more than that Karl Marx line about how history repeats itself versus tragedy than as farce. As far as Inskip sees it, even if history doesn't repeat directly, or even rhyme for that matter, it certainly echoes. So it's worth listening to the echoes of past Trump tariff actions to find out where we might be headed. First, take a look at a chart. This is a weekly chart of the S&P 500 from late 2014 through the very beginning of 2018. Now, the Obama administration actually tried to sanction a Chinese telco company in 2016 called ZTE, briefly prohibiting American companies from selling goods or service to them without a license. But they quickly backed down. In response, the stock market kept chugging along. But once Trump came in, we started an investigation of China's unfair trade practices for technology and intellectual property rights. Then he orders an investigation of Chinese dumping of steel and aluminum. Basically, they subsidize the stuff, and then their producers undercut us on price, crushing our own manufacturers. This has just been a constant pattern. By October 2017, the U.S. International Trade Commission was recommending safeguards to protect solar panels from Chinese dumping. So you can see this is a period of halcyon. We pull back from the ZTE, but then we go right forward. This was all the build-up to the trade war, and it didn't seem to have much of an impact on the averages. Even though the Federal Reserve was gradually raising interest rates during this period, Inskip says that the S&P 500 was still in a bullish trading cycle, with the 13-week, 26-week, and 40-week moving averages trending in the right direction. Remember, she likes these time frames because they represent one, 2, and 3 quarters, respectively. And we know we think about quarters on Wall Street. Now, let's take a look at this next chart. Check out the action in the S&P from mid-2017 through the very beginning of 2020. This is where we start to get the real tariff action from the first Trump administration. As Inskip points out, things get a lot more volatile, don't they? Trump imposed tariffs on steel, aluminum, solar panels, and washing machines, among other goods. All these helped the industries in question, but the broader market didn't like that we were triggering a global trade war. Sure enough, between January 22nd of 2018, and December 24th of 2018, the S&P 500 lost 18% of its value, all right? Of course, some of that's because the Fed got much more aggressive about raising interest rates during this period, taking them up 100 basis points that year. But it definitely wasn't just the Fed. You can see from the chart that virtually every time we got more tariffs, the S&P would roll over. Every time China retaliated, we'd sell off. So you're looking at this. All right. Of course, once the Fed decided to stop tightening at the very end of 2018, the S&P was finally able to find a floor at the 200. This is the 200-week moving average. You see that's the intersection of the floor. And then it just rebounded like crazy. According to Inskip, that catalyzed a bullish trading cycle, one that continued until COVID hit in 2020. Long story short, the market couldn't handle the trade war when the Fed was tightening. But as soon as the Fed started easing, well, those losses evaporated. What does this mean for the present? Let's take a look at a weekly chart of the S&P going back to October of 2023, unlike 2017 and 2018. The Fed is now our friend, creating a much more benign environment for the bulls, okay? Of course, we know from back then that Trump used tariffs as a bartering tool, with the averages selling off sharply nearly every time some new tariff threat materialized. But as soon as the Fed stopped tightening, okay, as soon as it stopped tightening, the market stopped reacting as aggressively to the trade war. The Fed was in play, not the trade war. As Inskip sees it, something like a trade war can certainly hurt us badly when the market's already trending bearishly. But if we got a bullish trading cycle like we do right now, then she's not worried as long as we can maintain that cycle. Right now, Inskip notes that the S&P 500 is very much in bull mode, supported by key technical indicators. It found a floor of support on Election Day at the 13-week moving average, triggering a short-term rally. The 13-week, 26-week, and 40-week moving averages are all acting as strong support levels. Even if we get a big breakdown from here, Inskip thinks we have a very strong floor at 5757. As long as that level holds, the bullish trading cycle remains intact. Wow. In that case, she's betting the S&P can digest the damage from a trade war, in large part because the Fed's our friend right now. When the Fed's your friend, it's easy for the bulls to sweep all sorts of negatives, including tariffs, under the rug. Finally, what about short-term catalysts? All right, Cramer fave, Nvidia reports tomorrow after the close. So check out the weekly chart of Nvidia going back to October of 2023. Pretty dispositive. Inskip wouldn't be surprised if Nvidia, now the largest company in the world, can set the tone for the remainder of the year with this report tomorrow. Wow. Putting aside the quarter tomorrow, but I have no idea how it was going to pan out. Inskip notes that Nvidia's got a bullish trading cycle with 13-week, 26-week, and 40-week moving averages sloping upwards. And that's, yeah, it's got floors of support there, too. At the same time, it's faced resistance from 131 to 140. Right now, the stock's at 147. And if it finishes the week above the 140 and change, that would represent a major breakout for Inskip. Of course, we just think, well, you know what, it could go like that. But she's thinking about a longer-term major breakout based on all these different lines. In her view, Nvidia has the power to trigger volatility, diffuse it, depending upon how the quarter pans out. If the company beats earnings and offers us positive guidance, that could get this whole market out of the woods. I think that's a lot to put on Nvidia. I don't know if it can do that, but I'm pointing it out that she thinks it can. Here's the bottom line. The charts, as interpreted by Jessica Inskip, suggest that tariffs had little impact on the market until they actually materialized during Trump's first term. All the saber rattling beforehand didn't do much damage. Even when the tariffs actually hit and the market sold off, we eventually erased those losses the moment that the Fed stopped raising interest rates. So until the tariffs actually hit, Inskip says you can take a page from Taylor Swift and shake it off. You know what? With the exception of the Nvidia comments, because that's too much to put on Jensen Huang and his team, I think she's got a real good point. Let's go to Manal in Georgia. Manal.
Oh, yeah, Jim.
Booyah.
Thanks for taking my call and guiding me all these years about the investment strategies. Thank you so much.
That's what I want to be doing. Thank you. I want to be a guide and a teacher, not a trader. I don't like trading. How can I help?
Yeah, I'm interested in CrowdStrike Holdings. The ticker is CRWD. I have been watching this stock, and is it still a good time to enter?
We bought some stock this morning for the trust. Why did we do that? Okay, because the stock was down because of whatever was going on in Russia, and we felt that was a great opportunity, and I feel very good that we did it because there has not been a day that this thing doesn't seem to be going up, up, up. I still like the stock very much, but we did get a better price during the Russian scare that we got this very morning. Thank you for those kind words about what I am trying to do here after more than 19 years of going at it. All right. The charts interpreted by Jessica Inskip suggest that until the Trump tariffs actually start to take hold, it's not helpful to fret about when it comes to your investments. It won't make you money. I think she's got a good point. There's much more mad money, including my exclusive with AeroVironment, fresh off its announcement to acquire a defense tech company, Blue Halo, that can play offense against other drones. Then what's ahead for oil and gas following Trump's pick to lead the Department of Energy? I'm going to tell you where I stand on this sector and the quizzical choice that he made. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.